want to get it, and when you want to get them, have them get that, okay? And when I say when, I'm talking about before death, we'd call that a gift. At death, okay, might be through the will, or maybe you looked around the kitchen table at the dining room and said, you know, maybe we ought to skip a generation or two here, okay? That'd be post-death, right? So we've got a lot of opportunity to make some of those decisions. So again, you want to work closely with your legal team as you set this up, depending upon how complicated your estate is. Okay. Now, a lot of you are involved in agriculture, trying to transfer businesses, and that requires some special work. We'll talk more about that as we go through here. But again, we're talking about what? We're talking about retirement planning. We're talking about estate planning. We're talking about business planning. And certainly a lot of income tax planning gets all weaved into this one bucket. Okay? Right now, many farms are dealing with old C corporations that were set up in the 1970s. They're an income tax nightmare. Okay? Easy as far as estate planning, transfer planning, but they're a nightmare for income tax planning and retirement planning. Okay? A lot of those have been very successful. As a matter of fact, the more successful they've been, the more difficult it is. Okay? So again, this is just my 3 steps. Okay? What do you have? We'll talk about calculating that. Who do you want to have get it? And how do you want them to get it? Okay? Keep in mind that you might have different buckets in your estate plan. You might have a bucket that holds cash, okay, or cash equivalents. You might have a bucket that holds a century farm, okay? You might have a bucket that holds an operating entity that owns a beef feedlot, okay? You might want to treat these buckets differently as far as how you transfer them, when you transfer them, and how you manage those, okay? A lot is always said about communication, okay, goal setting. I'll talk a little bit more about it later on. We started off a few years ago with a $40,000 grant, put together a 100-page booklet that talks about all the things that I think you would need to start down an estate plan. Okay, my book is free online. Okay, I'm not in the business of selling books. We'll talk more about that. But one of the things that we put in that was a section on goals. Okay, and that's really where we ought to start. There's a goal sheet. Dad ought to do one, and Mom ought to do one, and then they ought to look and see how they match up. And boy, won't that be an interesting discussion. Okay? All right. So, again, the idea is to figure out what you do with those assets. Are you trying to pass on a business? Okay? You're trying to plan for retirement. You're trying to jumpstart some of the kids' is tax avoidance your main thing. Okay? So what's really your priorities? Okay? So if you can identify those priorities to your estate planning and business transfer team, then you can start to put together some strategies. Okay? If you don't put those goals down, you'll do a couple of false starts, get frustrated, and give up. Okay? So the idea is, behind this book that we put together, was what can we do to increase our odds of success, to really break down this whole issue to the basics. Okay? So, you know, again, maybe you're worried about taxes, maybe about probate costs, maybe about protecting property from other non-related parties. And again, I'm reminded here of a family in my office about 2 years ago. They were talking about gifting to their children. You like that idea? Yeah, okay, yeah, he likes that. Yeah. And so they were about $2 million worth of net worth, and then we get over to well, I shouldn't say they had $2 million worth of assets. Then we get over to the liabilities column. We managed to find about $1.2 million in debt. And so I told the people that you don't meet my basic test for gifting. You don't have $1 million net worth. So one of Kelvin's rules is we don't give anything away unless we've got over $1 million in net worth for the older generation. I'll talk about the golden rule. You understand the golden rule, right? Okay, we'll see if you do. All right. So first of all, we usually start off by taking a look at how's property owned, okay? And you'd think that'd be a simple question, but it's not. We got life estates and remainderments, and geez, I had 5 dysfunctional children in my office here about a month ago. They were all over age 65, but they were certainly dysfunctional children. fighting over an 80-acre tract. 2 of them wanted to sell it. 2 of them wanted to keep it. One didn't know what he wanted. And after 2 hours, he was still confused as to what he wanted. Okay? So that was my limit on free time, was 2 hours of dysfunctional discussion. Okay? There might be some insurance out there. We might take a look at gifting, other ways of moving property around. Okay? But again, we'll just go back and talk about goal setting. Parents do it. I like to see them do it individually, then come back and figure it out together. Maybe have some discussion with on-farm heirs, off-farm heirs, as we tie that all together. Okay. So I start off by saying, well, what do you own? Okay. And that usually goes back to the balance sheet or the net worth statement and taking a look at that. Okay. We usually break it down into real property. Okay. So that's the real estate. Well, land values, I'm from up north central Iowa, land values have done really well, but we're starting to shrink that number back down a little bit. We've probably taken close to 20% off the value of land in the last 12 months, I would say. Some of the surveys don't show that, but we'll see that in actual sales, I think. Okay? So how do you own your farm? Well, you might own it individually. Okay? It's fee simple. You might have had a life estate, a life tenant, remainder interest. I might mention one of the things in our book happens to be a vocabulary sheet. Okay? So as we've done these programs, we figured out that when I talk about a remainderman, most people don't understand what that means. Okay? So again, think about that. Okay? So do you own it with anybody else? Like a tenant in common. Okay? So when you bought that farm, did your wife convince you to put her name on it? Okay? Or did you just buy the farm in your wife's name and not even put your name on it? Probably not, but okay. All right. So we may have done joint tenants with right of survivorship. So when I was young and excited and in love while I got married, bought a house, then bought a farm, put my wife's name on them both as joint tenants with right of survivorship. And now I'd like to leave that farm to my children and have my wife have life estate on it. Can I do that? Not without her giving up that title and retitling that property, okay? That's not a good conversation to have either, all right? So we're in the business of a lot of conversations that don't always go well, okay? So tenant in common, that's an undivided interest. You know, these 5 people showed up, and they're telling me that they own like 17 acres. No, you don't own 17 acres. You own 1/5 of an 80, okay? There's a difference. Okay, a big difference. So you got tenants in common, and that interest passes according to their will or whatever else is set up for the ownership for that property to transfer. Okay, so only the part that's included in the decedents gets included in their estate. Okay, joint tenancies. This is the thing you need to highlight right here. Joint tenancy takes precedent over the will. Title takes precedent over a will. Okay. So you can put in there, I can put in my will that my children should get my half of the farm, but the reality is, it's titled joint tenants of right of survivorship, my wife's going to get it all. So I have to outlive her. That would be my strategy, right? Okay? All right? Those are magic words of conveyance. Okay? Sometimes you have joint tenancies with non-spouses, right? Okay? So again, you go back and take a look at how it's going to be taxed, and it's considered furnished rule. Okay, so if Aunt Mabel and I own, well, let's just say Aunt Mabel has a $100,000 CD in the bank, and she puts this young man's name on it, okay, as joint tenants with right of survivorship. Aunt Mabel dies. What are you going to do? I can tell by looking at him. He's going to walk in the bank and get that $100,000. Okay, he's not going to pay any inheritance tax if there's any inheritance tax due on that. He's not going to pay any federal estate tax if it's due on that. He's going to let somebody else worry about that. The inheritance tax, I will come back after you. Okay, but the reality is that $100,000 included in Aunt Mabel's estate? Well, yes, it is, because that was all of Aunt Mabel's money. We'd have to prove that you contributed some of that, and since I doubt you did, you know, we'd go back and include that. All right. We'll talk a little more about the unified credit later on, and a lot of estate planning now has disappeared because of tax issues. Basically, a husband and wife has to have about $11 million in their bucket before we have to worry about federal estate tax. Okay, So with inflation indexing, we've really seen that bucket jump up quite a bit in size. All right? So spousal tendencies, we generally think that if you die, the first spouse that dies, that is joint tenancies, that half of the value of that farm is included in that first person to die, and the other half will be included in the second person's to die. Okay? It's called the fractional share rule. All right. Well, a little bit about inventory. We all have good inventories, right? Yeah, right. Okay. Depreciable machinery. Well, what's the good news about dying? You ever thought about that? Huh? Yeah, you thought about dying, huh? Is there any good news in dying? Well, the good news is that many of our assets get a step-up in basis. Okay, so our heirs can sell them tax-free. So the new widow that called me last week that's got about $500,000 in equipment, we're going to do what? We're going to get to sell all that equipment and not have to worry about recovered depreciation. It's a tax-free event. Okay? So again, when we think about estate planning, we're looking at timing on the transfers and the tax basis come into play. Okay? All right, so I've got to make up a little bit of a time here, and so I'm going to flip through some of these slides fairly fast. But the balance sheet, okay, for a lot of people out there, it's pretty basic. We got a little bit of property. We don't have any debts. We just got some net worth. Okay? That's not a problem. Okay? Now, those of you that have been filling out financial statements, hopefully you can read them right side up instead of upside down. The lender hasn't been filling those out. But again, why didn't that get saved right? Okay. This should say $5.43 million. I think it does later on. The 2015 number, I'm assuming everybody in the room will live to be 2015. Okay, so that number is now indexed. This is the 2014 number up here. The 2015 number is $5.43 million. Okay, so in my looking at balance sheets, the first thing I do is, what's in the bucket? Well, if it's less than $5 million, you can't screw it up for federal estate taxes. Okay? So everybody talks about federal estate tax. Less than 1/10 of 1% of the people are ever going to pay that tax. Now, I'm probably with a different crowd today, so you're going to be a lot higher percentage than that. But again, big pies, if you take, it would be what, $10.86 million for 2015 will be the new unified credit amount that you can have and not pay any. So I think about small pie, medium-sized pie, or your really nice big pie. Okay. Again, going back, thinking about these goals. All right. And what does your spouse want, or what do the children want to do? You know, are they interested in receiving income from that farmland? They want to be in the cattle business, running those cows. They want to be involved in management or not. Okay. And there's a lot of different things that come up in these goals, and if we had more time, we'd spend more time on those. But who gets involved? Well, it takes a lot of discussion, a lot of communication to start pulling this together. And again, it might be an attorney that's knowledgeable in estate planning. Always a question about in-laws sitting at the table. Okay, if you've got a farm operation and you got a son or daughter involved in it, and they're married, I'll bet you that their spouse gets to sign at the bank on those bank notes. Okay. And my personal opinion is that gives them the right to sit at the estate planning table as well. Okay, I've got a friend of mine that in my office that I work with that he brags about the fact that none of these in-laws ever attend any of these business meetings. I'm just finishing up with an estate case in Story County, and we've made really a strong effort to get the grandchildren involved in all the business planning meetings. In particularly, one of the reasons is that we're trying to illustrate to some of the grandchildren how poorly one of the parents behaves. Okay, and we've been very successful in that so far. Okay, so again, and maybe you got some of these things that work from one generation to the next that keep on coming back to bite you. You can get rid of some of those. There's a whole art in scheduling a meeting to have these discussions. I tend not to do these at the kitchen table. I don't like people getting mad and stomping out of the room. They stomp out of my extension meeting room. I don't feel bad. Okay, but again, how do we make these notices, these meetings, aware of that? So it's really easy in today's world of email. I've got one coming up here on a Saturday. We've got a client that lives out of state. We're going to Skype them in, okay? So we'll just use technology to bring them in from California to the Iowa meeting, okay? This is always a tough one, is how do we make decisions? What's the priority? Is it financial? Is it family? Who makes decisions? And how do we make decisions? You know, I've got some of these grandchildren showed up at this first business meeting, and they thought because they were there they got to vote. Okay? No, I didn't invite you in here to vote. I did invite you in here to listen and to discuss and to ask questions. But in the end, those of us that are in charge of that particular estate are going to make the decisions. Okay? I don't mind a little consensus. I don't mind a little collaboration. I don't mind some discussion about some things, but in the end, this operation is run autocratically. And that may not be that much different from a lot of yours. Okay? Running an estate settlement process might be a little bit different than trying to run a business. If you're trying to run a business, you might focus more on this end of the scale. The other thing I always think about is, how do you fight and work it out? Okay? If you can't figure out how to fight fairly and work out that discussion, you'll have a lot of issues. Okay? Again, there's some meeting rules that we put in place. I've had groups that had a ball they passed around. You couldn't talk unless you had a hold of the ball. Okay? You know, I've had, well, we're not going into some of those ugly stories. You people are all doing better than average. You're all from Lake Wobegon. Okay, so Christmas dinner is probably not the time to make these announcements. Okay? But you know, I've got a couple of rules when I look at intergenerational transfers and young farmers and starting farmers. First of all, I practice the golden rule. And I asked you about that. And what's the golden rule?
Do unto others as you would have them do unto you.
No, that's not right. No, that's who has the gold rules? Okay, all right. So yes, there are several. I was doing this program with a coworker that has a degree in divinity, and he decided that was the golden rule. Okay, now I don't practice that golden rule. Those with the gold get to make the rules. Okay. And that's usually the older generation, okay? And so, you know, but you need to have that discussion about who's going to make the rules and who's going to get to hold on to the gold and how the gold gets transferred, okay? Again, I never have parents co-sign for kids. That's just a bad habit to get into. The government's willing to co-sign for $1 million on most young farmers, so why would I have the parents? After they go broke the first time, I'll talk to the parents about bailing you out, okay? The other thing is on these generational transfers, geez, do we have a plan for taking this apart? We all sit down at the table, the lender's there, and the family's all there, and by golly, we're going to build this new cattle barn, and everything is going to go just wonderful. And we're going to make a lot of money and get rich, okay? I can show you a pork operation where I ended up with 4 brothers. It wasn't 2 years later on the front porch of their office swinging at each other, okay? Not the way to run a business. So that's my three more of my rules. Okay. So you got this bucket that's got stuff in it, maybe different buckets. How do you get rid of them? Well, sale, gift, estate. Those are the big 3, or a combination of those 3, right? So let's suppose we got 3 farms that we bought. The one was we bought for $1,000 an acre. We like that one. One we bought for $6,500, and one we paid $10,000 for, and they're all worth $6,500 an acre. So this was a heck of a good deal. This was okay, and this is what we call an oops. That's a technical term. We won't have any oopses out there. Oh, we might have some oopses out there again. It's been a while since I've seen a lot of oopses. Okay, so you wake up one day and you're feeling kind of generous, and you want to give away a farm to one of your kids. Which one would you give away? The cheap one, the $1,000 an acre one? Okay. Which one would you take? You'd take any of them. I can see that right now. All right. I got to vote for $6,500. Anybody want the $10,000 an acre one? Give that one away too. Okay. So the reality is that we're treated differently. If you die owning those 3 farms, this one gets a step up in basis. That's a good thing. This one, the basis won't change any. This one, you'll get a step down in basis, so that tax loss is forever lost. Okay? That just disappears. if you make a gift, the thing about a gift to remember is the donor's basis and the recipient's basis is the same. Okay? So I had a guy up at Fort Dodge, and he gave his kids the lowest basis farm that he had. And his logic was, if those kids ever sell that farm, I want them to have to pay the most amount of income tax possible. Okay? So he wanted the IRS to help him out with his estate planning. Okay? Not a bad strategy, I guess, if you want to use that. But anyhow, so if we give that overpriced farm to the children, again, the government doesn't like that. You're going to have a step down in basis to fair market value. And so the kids will only get a $6,500 basis. All right? Of course, we don't want to sell this farm. We want to die owning it, so we get that step up in basis. That avoids all that tax gain. This one would be a good one to sell. And if we can sell it to a non-related party and write off that loss, okay, that overpriced one would be the best one to sell. Okay? So, again, there's different situations. So each asset, you need to maybe think about what bucket is it in and how would you transfer that asset depending upon the tax issues. Okay? All right, so a lot of talk about gifts. And with the wealth that we've seen the last few years, there's a lot of gifting going on, even to fine institutions like Iowa State University. I had a guy walk in the other day to my office, wanted to give away $300,000 worth of machinery to the university. Okay, we would give him a CRUT back. Okay, a charitable remainder unit trust. Okay, so you give us $300,000 worth of equipment, we'll probably give him close to $15,000 for life as an income stream back. He gets a tax deduction. If you're in a high tax bracket, it's a pretty interesting opportunity. Okay, but more often we think about the annual gift exclusion. That's where this $14,000 a year number comes in. Okay, a lot of people think that's for related parties only. But, Gene, that's not for related party only. Old extension agents could even take that $14,000. Yeah, okay. Again, how might that work? Well, mom and dad show up, and they've got an only daughter at Christmas time, and so mom gets out the checkbook, and she writes out a check for $14,000, and then dad writes out a check for $14,000. Well, mom could write out both checks. You can actually give it all out of one account. So they could give their daughter $28,000 for Christmas. And then January 1st, she shows up after New Year's Day, and she says, well, I'd take another $28,000, right? So I get rid of $56,000 in a matter of a couple of weeks. Okay? Well, suppose she's married. Now I can get rid of $56,000 times 2, so I can get rid of about $112,000 tax-free in a couple of weeks. Well, suppose she's not an only child. Okay? Some of you maybe have 5, 6 children. So all of a sudden, we can move $750,000 in a matter of a few weeks out of a tax bracket, okay, by gifting. Okay? Again, you need to think about, do you really need to use the unified gift credit? Okay? So, let's see, I think, yeah. Okay, yeah. Make sure that if you give a gift and you want to qualify it for the annual gift exclusion, it has to be a gift of present value. Okay? So some of you guys got some of these old C Corps that got shares of stock, and they never pay a dividend, all right? And they got all kinds of restrictions on who can buy those, okay? Is that a gift of present interest? I'm not sure that it is. You ought to get a legal opinion on that before you assume that it is, okay? When my mother gives me $1,000 for Christmas, and I go out and buy whiskey with that, I know darn well that that's a gift of present interest, okay? You give me $1,000 worth of stock in your old C Corporation, I'm not sure that that's really a gift of present interest. Okay? Think about that. All right. That's the estate settlement process. Okay. So if we do that, we petition the courts, we're going to look at those 3 things. Pay debts, pay administrative costs, pay any claims. All right. So dying with a will, again, there's an appointment of the executor. We've got a whole 3-page article in our fact sheets on this, okay? And so the executor has to be appointed, okay, and has to accept, all right? And then you start down this process called probate, okay? So inventorying the assets and settling disagreements, whether that's among family or creditors, and getting good title, all right? Do we have multiple executors? Do we have triple executors? Well, if we start doing that, who gets to write out a check? Who has authority to control the checkbook? A lot of issues you got to think about. my thought is, pick out one kid and suck it up and tell the other one's too bad, okay? You're not the one, all right? Now, a lot of times we end up with an on-farm heir and an off-farm heir being co-trustees, and we think that'll balance out the power, and it may or it may not, okay? This is the key one here. People don't understand that beneficiaries really don't have many rights, okay? People say, well, they don't tell me anything. Well, they don't, okay? The probate attorney, who does he work for? He works for the estate. He doesn't work for the executor, okay? He doesn't work for the heirs, okay? You can get disbarred for working for the heirs, okay? You can lose your ticket to practice, all right? So, again, we're not going to worry about these. You're going to all have you can go to look at the code, okay? All right, we're not going to worry about those slides. This is how we pick up a little bit of time. All right, making out wills. There are a lot of court cases on competency. You notice some of you get a little older, you start forgetting a few things. You got your little book to write things down so you don't forget? Not yet? Okay. I got to have my book yet. So there's some things there, but we get two things: are they sound? Are they legally sound mind to make out a will? And then the other thing is, were they coerced? Okay. Again, oftentimes we have a special bequest list. Aunt Mabel, if you don't come and visit her at Christmas time, she writes off the rocking chairs she was going to give you. She can just do that on her little list. Okay. Keep in mind that wills are valid in the state that they're written in, and also keep in mind that if you have property, like in Florida or Arizona, I was in Dalhart, Texas last week, and Phoenix last week, you might want to put that property into a trust so you don't end up with ancillary probate, doing probate in two different states. Okay? So make sure that you talk to your estate attorney about property that you own in other states. Okay? And you might want to find out what the estate tax laws are for that state. Minnesota's kind of a harsh state when it comes, if you've got your fishing house up there. Okay? All right. Okay. We're not going to spend a lot of time on that. Okay, so we talked a little about basis, the idea of you get a step up or step down. Okay, we talked a little bit about gifting, income in respect of decedent. We could spend a lot of time talking about that, but bottom line is, don't sell a farm on contract and then turn around and die in the next year or two. Okay, that's poor planning. Okay, why would that be poor planning? Well, if you kept the farm and died owning it, you'd get that step up in basis, and that $300 an acre land would all come to the children tax-free. If you sell it on contract and then turn around and die, the heirs inherit that contract, and they get to pay the capital gains tax and the interest income on that contract for the life of the contract. Okay, so a contract for sale would be income in respect of decedent. Bonds would be income in respect of decedent. Okay, keep in mind sale of residence. If you move off the farm and you want to sell the acreage, you can sell the acreage tax-free. Okay. So a lot of times we say, well, I can't sell the home place to the kids that are farming there because I'd have to pay income tax. No, you don't. You can get rid of $500,000, husband and wife, of sale on your primary residence tax-free. So that's an opportunity. Again, we'll have some private sales, installment sales, private annuities. Okay, we'll talk a little about special use valuation these days. $1.1 million could be excluded from your estate if you met certain rules. Okay, farmers are special. You've always known that. Okay, so we have back in the 1980s, we had 70s, we had high land values, and so we got special use valuation. So it's a tool to use in your toolbox if you need it to get rid of about $1.1 million worth of valuation. The federal estate tax bracket is 40%, so it would save you about $440,000 in federal estate tax if you needed it. Okay, not the last tool. Okay, gifts of farm assets. Okay, so a lot of times in trying to help a young person get started or in moving assets around, we'll make gifts. Okay, sometimes we'll make gifts of grain or livestock. Okay, again, keep in mind that the donor's basis and the recipient's basis is the same. Okay, so I'll bet you there's somebody in here that's giving grain to the church. So you took the grain, you hauled it out of the field, you dried it, you put it in the bin. After the first of the year, you take and deliver that grain to the church. Well, you deliver it to the co-op and put it in the church's name. Okay? What's your tax basis in that grain that you take to town? Well, it's zero because you've written off all the costs of raising that grain. So your income tax basis in that grain is zero. You take it to town after the first of the year. The basis went from what it cost you to raise it back down to zero. The church sells it. Okay? Does the church care what the tax basis is in that grain? Nope. They don't pay income tax, so they don't care. All right? Again, it's a tool to use. Maybe you've got a wayward nephew that does a little bit of tractor driving for you, and you'd like to help support his standard of living. Maybe paying him with grain might be a way to do that that's cheaper than paying him wages. All right. So if we come up with federal estate tax, federal gift tax, we can give away quite a bit. Of course, there's the annual exclusion, the $14,000. There's the marital deduction. You can give your wife everything. Okay? So if you don't have that farm titled right, she can just go and have it retitled. Oh, okay. All right. So unlimited marital deduction, unlimited charitable deduction, and then the unified credit. Okay. So we really haven't talked much about the unified credit, but that's the credit you have for either gifts or death tax. Okay? We call it unified because you can use it during life, you can use it at death. If you use up some of it during life for gifts, then you don't have as much left over at death. Okay? So if I've got the widow Smith and she owns $1 million worth of real estate and she wants to give that all away to her favorite grandson that's farming that, can she give that all away tax-free? Well, the answer is yes. Okay? She could use her $5 million of unified credit for that gift during life. Okay? Give away $1 million worth of real estate. And then, basically maybe impoverish herself even and not pay any gift tax. Okay? If she's only worth $1 million to start with. Now, there's some things about Title 19 and 5-year look-back rules that we need to keep in mind as well. All right? Unified credits. Okay. Oh, yeah. Gifts that we don't think about. All right? So, interesting one. I had a Bubba. Okay, I'll talk about little Johnny and Bubba. Okay, but Bubba here, I was doing an estate meeting a year ago over in Marshalltown, and Bubba came up to me afterwards and wanted me to help him explain to his siblings why he was not a lowlife. Their mother had recently gone into the nursing home, and the children, his siblings, had gathered around Mother and looked at her checkbook, and they wanted to know where the money was at. Okay? And they discovered that Bubba had been paying $100 an acre rent, okay, last year, all right? And they wanted to know what the previous year's rent was. And they couldn't find that check because Bubba had never written out that check, right? Okay? So he wanted me to help explain to his siblings how what he was doing was okay. Well, no, that's not okay. As a matter of fact, the Iowa Department of Revenue would not think that that's okay because they're not going to put Mom on Title 19. They're going to want Mom to sell that farm. Okay? So when you start looking at transactions, there's a whole variety of transactions, maybe market interest rate loans, rental rates below market value. These start creating gifts. Okay? And just be aware of that. Now, that's the nice thing about agriculture is it's pretty darn easy to cheat. Not that you guys would cheat, but it's pretty darn easy to, okay? Think, what's the size of my bucket? Well, it's fair market value. That's the willing buyer, willing seller test. The exception of that is special use valuation where you can knock off $1.1 million. All right. If you were over that and land values started to crash downward, the government will let you reevaluate it 6 months later, okay? So that's one way. Again, that special use valuation. All right. All the valuation dates, yeah. We're not going to worry about that. Okay. So again, going back, tenants in common, usually 1/2 the value gets included in the gross estate. Joint tenants, usually the considered furnished rule for non-spousals, and 1/2 for fractional share for spouses. Okay? And again, you can go look at, that's joint tenants with right of survivorship, right? Okay. Some gifts get special attention. Some transfers, I should say. Gift of a life estate. So maybe you have a retained life estate. You decided You didn't really want that back 80 acres anymore. We wanted to give that to Gene, so we just deeded that over to Gene, but you kept the lifetime income. Okay? So you want to keep the income stream for life, but you want to make sure you know where that asset goes, so you'd have a life estate set up. Okay? Transfers at death, revocable transfers. So I set up a trust. We'll talk about trusts later on. I've got this revocable living trust. It says I can bring that stuff back. Okay? If I've got to keep strings on it to bring it back, it's going to get included in my estate. Transfers of life insurance is another one. 2-year look-back rule on those. A whole bunch of rules, actually, on life insurance. If you're moving that around, you need to talk to somebody who's got experience in the tax attributes of life insurance. Okay? Retirement benefits, guys like me that have almost all of our retirement income stuck into TI-CREF, we don't get a step-up in basis in those assets. And then there's special rules. For gifts, we go back to 1976. Okay. So you got a really big pie. You get to deduct some things. Okay. Debts, of course. Marital deductions, that's the big thing. If you have to pay Iowa inheritance tax. Okay. All right. So again, we talk about these planning sizes. Okay. There I've got the right numbers in for 2015. Okay. Again, small pie, you're not going to worry about tax. You're going to think more about legal costs, getting it to the right place, focus on income tax, and maybe asset protection is a big part of it. You got a medium-sized pie. A lot of things to think about there. Oli and Lena, if something happens to Oli, is Sven going to come down the street and start visiting Lena? Not sure about that. Maybe there's some things you want to do with a life estate or a trust if you're worried about Sven showing up. Okay? We'll talk about portability here in a minute. Okay? Well, Sven might like to go on a cruise. And, I told my wife, I said, I keep an inventory sheet of these widows. I've got a sheet that says how many acres they own, okay, and what they're, sometimes even got the rental rates on them. All right? You interested in seeing my sheet? All right? Okay. Portability, that's the new vocabulary word. We'll talk about that a little bit here. It started in 2011, and it's a new tool. Big pie people. So you got over $11 million in assets. Does that mean you should have to pay federal estate tax? Well, heck no. This is the United States. You shouldn't be obligated to pay tax if there's a reasonable legal way to avoid it. Okay? And there are many, many of those ways. Gifting programs, charitable donations, special use valuation, charitable remainder unit trusts, charitable remainder annuity trusts, minority shareholder discounts. Okay? A good estate planning attorney can probably take a $20 million bucket and not pay any tax on it. Okay? So those people that have big pies need to focus on getting the right kind of help. Iowa inheritance tax. You can go up the tree or down the tree without a problem. Okay? So children, grandchildren, tax-free. Okay? It's these nieces and nephews that we have trouble with. All right? Or brothers and sisters in the case of the bachelor brother that leaves it. Okay? So they'll get a piece of the pie ranging from 5 to 15%. But children, grandchildren, we can go down the tree or up the tree, tax-free for Iowa inheritance tax.
That's not adopted children.
Yes, that is adopted children. I think it is adopted children now. Yep. Yeah. Okay, this is Aaron Herbold here, sitting here with Beaving Law Firm. And they do some work for the cattle producers. And Aaron and I have worked together for a number of years. Okay, so she can help bail me out. No, you don't know what many, many years are. Yeah. Okay. So, oftentimes we get excited about what the administration fees are. Iowa Code says that an attorney may charge $220 plus 2%. Okay. It doesn't say thou shalt charge. Okay. So you can negotiate those executor fees ahead of time. We certainly see a lot of that done. We see estates being settled by the hour. But before that attorney gets appointed as executor, and again, I think you have to look at what's in my bucket. Is it a $50,000 bucket or is it a $15 million bucket? Okay. Believe me, those small little estates are time-consuming and painful. okay, as we've been dealing with one, okay? All right, so maybe you have to pay some tax. Well, you got a lot of cash. I've noticed some of my clients have $1 million in cash laying around, okay? Maybe you have some life insurance. Oh, if you do have to pay tax, I'm here from the government to help, okay? Because I'll let you pay for it over 15 years. The first 5 years is only interest-only option, okay? And I'll charge you what? A whopping 2% interest, okay? So again, if you're going to have to pay tax, you want to see that you're qualified to qualify for this program, okay? And again, you ought to be able to borrow some money if you're worth that much. Okay, so the unified credit that we talked about is used either to offset gift tax liability during life or death tax after death, okay? And as long as you don't burn through that unified credit amount, you're in good shape. Once you burn through it, we now have a flat tax of 40%, okay? So whether it's a gift that you burn through or estate, okay. I mentioned the word portability. Okay, so that's a new concept that came out in 2011. Some congressman somewhere had a problem, or he had a constituent that had a problem. Okay, and basically, if we think about Ole and Lena, okay, and Ole put about $1 million worth of real estate in Lena's name, and he had about $9 million worth of real estate in Ole's name, right? Smart man, that's right. Realizing that if Lena went down the road, she was going to pick off half of that anyhow. But the reality is that Ole was planning on what? Ole was planning on dying first, okay? And he would take and put $5 million into let's say he used a life estate. So that $5 million worth of assets went to their children, and Lena got the income for life, okay? And then Lena got the balance of his $4 million. So now Lena's worth $5 million. Lena dies, okay? And so how much tax do we have to pay? None, okay? But let's suppose that Ole screws up and Lena dies first, okay? So Lena dies, $1 million, okay? No problem. But Ole's now left with $9 million. How's he going to get rid of that other $4 million tax-free, okay? Yeah, spend it or gift it, okay? Or spend, yeah, spend. I don't think so. But anyhow, so what portability says is that if Lena dies first with only $1 million of assets, Ole can reach back and grab her unused $4 million credit and add it onto his top of his $5 million credit. Okay? Neat little idea, all right? So your attorney says to you, I'd like to charge you $1,000 extra to fill out the portability form. Well, should you do it? Well, if Ole and Lena were only worth a couple $1 million to begin with, and Lena left everything to Ole, and so he's still only worth a couple $1 million, probably not a big deal. Unless we had a lot of land inflation, and Ole died when land values were high, and Ole's children came in and thought, what? This must have been an incompetent attorney. We should sue him for malpractice because we should have filled out the portability form. Okay? So anyhow, it's a new concept, relatively new out there. And so you need to think about order of death, okay, and how we might be impacted by order of death, but will portability cover up some mistakes in how we have property titled and tax issues that we face, okay? So, again, if you think about where we're kind of at today, I can take a husband and wife with $10.86 million of taxable estate, get rid of all the tax liability by using portability. I can also have the option, we still have generation skipping, okay? I mentioned that you looked around the kitchen table and you saw the guy sitting there and you thought, well, geez, maybe we ought to skip a generation. Okay, so you can use your credit to do that. So you'd have $5 million to skip that you could do. Okay, and so we'd launch that up into space. It depends upon how young your youngest living grandchildren is, but I'm talking about we can throw it up there for 100 years and the IRS will never get to tax it. Okay, so that might have some appeal. Gifting, like I say, we can do a lot with gifting, and then after that we hit this 40% tax bracket. Okay. These are Ole and Lena stories. We're going to pass those up. Okay, I want to talk a little bit about family businesses and because it's such a big issue. And we've got the issue of fair versus equal. Okay? Now, when you're talking in front of a farm group, you're always supposed to talk about little Johnny. Because little Johnny came home and worked really, really hard and helped the folks make a lot more money. And he helped the folks build up their net worth. Okay? You're not supposed to talk about Bubba. Okay? People don't like it when you come and talk to farmers about Bubbas. Okay? Bubbas that came home and sucked up resources. They got really low rents, got use of machinery and equipment for nothing, got all kinds of freebies. Grandma did all the babysitting and cooked most of the meals. Okay? And by and large, a lot of people aren't very good at figuring out whether they were really a little Johnny or a Bubba. Okay? In my line of work, I see an amazing number of Bubbas. Okay? All right? I could work with Bubba situations full time. Not fun work, but we could do it. And so I think one of the things to think about is ownership versus control. So my thought is farm businesses, on-farm heirs, ought to have control of the assets, not necessarily ownership. Okay? This is a big issue. We tend to think about ownership being key. Off-farm heirs deserve a reasonable return on that assets that they've got out there. Okay? My thought is that if you got another generation working on the farm, compensate them what they're worth at the time that you're doing it. Okay? I've seen a lot of problems in the dairy industry in northeast Iowa where little Johnny was working on the dairy farm and the folks said what? Well, didn't make any money this year, but we'll take care of you when things get better. Well, we had a whole string of years where we didn't make any money, it seems like, and we're still trying to take care of that. And so you end up at the end of the time frame, and you'd have no idea what a reasonable compensation is. And people aren't very good at understanding, $1 to this young man back here with the beard today is worth a lot more than will be $1 to his sister in 30 years. Okay? But somehow parents tend to think, well, I gave Bubba $1 when he was 25, and now 30 years later I can afford to give his sister $1, so those dollars must be equal. Okay? You suppose children realize there's a difference? Most of them do. Okay? On the other hand, I don't want to see a 57-year-old farmer sitting at the kitchen table trying to figure out how to pay off his two sisters because they want to sell the farm. Okay? At 57, he's probably not interested in borrowing enough money to buy out his two siblings. We really need to think about, could we have put that land in a trust? Okay? And could we have set that up so that the on-farm heir had the right to rent those facilities? And maybe we ought to just, if you can't make it at the going market rate, maybe we'll have to discount that rental rate. Okay? But let's make the parents bear the burden of why we have a difference in how we treat the children. Okay? And, everybody tells me that they treat all their children equally. And if I go to Grandma's house at Christmas and I look at each of the grandkids' stockings, there's going to be the same amount of money in each stocking, right? Okay? That's about the only time we treat our children equally. When your sister got braces, did they give you $3,000 cash to go out and buy a car? Oh, you had braces too. Okay, so you got your fair share. All right? What time is it? 11:32. Okay, we're doing all right on time. Okay, so that's part of this challenge is, can we do things to protect those that need to be protected? Okay? At the same time, treating the others in a reasonably decent fashion. Okay? This 5 dysfunctional children, I don't know what their mother was thinking when she decided that the 5 of them should farm together as landlords, but obviously that was a poor decision. And the attorney that drafted up that one-page partnership agreement that didn't have anything in there about how we dissolve the partnership was also another poor decision. Okay? A one-pager wasn't what those people needed. They never got along as kids. I don't know why Mama ever thought they would get along as business partners. Okay? All right. So let's talk about trusts. Interesting tool, quite popular. Nothing magical about these things. you've got some property, you got somebody who's in charge of taking care of things, you got somebody who gets the benefit, and then you got a rule book. Okay? So I can take almost all trusts and break them down to that basic set of facts. Okay? So what's the property? That could be cash, that could be land, that could be shares of stock in an LLC, could be a lot of things. Okay? So again, trusts might be revocable or irrevocable. Revocable means I wake up tomorrow morning, I think I screwed up, and I want to take it all back. Can I do that? If it's revocable, yes. Okay? If it's revocable, it doesn't have any impact on your estate taxes. Okay? It doesn't have any impact on anything, really. It will get a step-up in basis at your death. Okay? So when I look at trusts, probably 90% of the trusts that are written today are revocable living trusts. All right? The Mary Smith Revocable Living Trust. Mary Smith put the property in. Mary Smith is the trustee. Mary Smith is darn well the beneficiary. And Mary Smith and her attorney wrote the document. Right? And if Mary Smith decides that she doesn't want to have that property in that trust anymore, she can pull it back out. Okay? It's a disregarded entity for income tax purposes as well. Okay? Now, in these trusts, irrevocable, might be used. Oh, I had an acquaintance of mine that was in the construction business. He had a construction business building roads up in northeast Iowa. They got a couple of state contracts. They're going to make a ton of money off these contracts. What do they want to do? Dad already is worth well over $25 million. He doesn't want any more money. Okay? So he gifts all of his shares of stock, his half the company, gifts to his grandchildren in an irrevocable trust. Okay? So basically he's trying to freeze the value of that asset and get it out of his estate. Okay? So you'll see a few of those irrevocable trusts set up. Okay? If the trust goes beyond the death of the person that set it up, okay, the settlor or the donor, then it's going to become irrevocable. And these trusts might go on for, like I say, upwards of 100 years or so. Okay? Oftentimes when you do a trust, they'll set up a pour-over will that says if I screwed up and didn't get my assets retitled back into the trust like I was supposed to, the will dump them back into the trust. Okay? So, again, these are quite common. And again, you can have multiple trusts. You got different buckets of assets. My last case with Bubba that we're working with, I sat down with Mom and I said, you know, Mom, you're getting up there. Hair is just as white as this gentleman's. Okay? And by golly, you know, you want to take care of your son after you die. Because I says as soon as you die, your C corporation, all those shares get dispersed to your children, and they're going to vote Bubba off the island. Okay? And she says, well, I can't do anything about that. I said, well, yes, you can. So what we set up was all of Mom's cash-like stuff, okay, so her investments, they all went to the children when she died, but the shares of stock in the C corporation went into a trust until Bubba turned 66. Unfortunately for Bubba, he turned 66 last month. Okay? So last month at the board meeting, we announced to Bubba that we were going to take away his pickup, we're going to take away his health insurance, we're going to take away the house that he lives in, because the corporation happens to own that. He can either buy it or pay some decent rent, okay? And we're going to take away your health insurance, okay? How's that sound? Huh? Okay. Huh? Poor Bubba? Okay. So Bubba has, this is really an unfortunate case. And I'd like to go back and change history a little bit. Because when I think about Bubba, has Bubba ever bought a house on his own? Has Bubba ever bought a vehicle on his own? Has Bubba ever paid for his own health insurance? Okay? You know, and so all of a sudden Bubba has got to grow up. We've treated him like a 14-year-old for 40 years. And now we're saying, grow up. And he's not liking it. Okay? Now, you know, that's why I brought his children in to watch him behave. Okay? interesting scenario here. But again, you know, if I wouldn't have protected him until he was 66, this would have happened to him when he was 56, possibly. Okay? So that was the compromise. So, you know, Mom had the gold, and I practiced the golden rule, and Mom said she wanted to take care of Bubba till he turned 66. Okay? So all these siblings have been sitting out there with these shares of stock in this corporation that were gifted to them 30 years ago, never got a dividend, have they? Not one dime. They used to come home and see how much gas they could steal back when we had gas tractors. That was how you got your dividends. Okay? All right. Questions about trusts? Okay? I want us to take a little moment here and just talk about trusts for a moment. Yes, back there. With these old corporations, you have to realize that there's tremendous, if they've been successful, there's a tremendous amount of tax liability built into those corporations. So they all should be discounted, at least when we're trying to get assets out of this C corporation with Bubba, we're looking at the 54% tax bracket. Okay? 54% tax bracket. So you got to get a significant discount. And one of the things to keep in mind is you may set up a plan where the corporation buys the shares of stock back, not the individuals. And so we're looking at the first thing that I did with the siblings was, does anybody want to get out of the farming business? Do you want to sell your shares of stock? Because we've got enough cash in this old C corporation to redeem at least 20% of the shares, just buy them out. Okay? Remember that the children that inherited these shares of stock got a step up in basis in the stock, not in the underlying assets. Okay? So the farm ground is still valued at $400 an acre inside the C corporation, even though the shares of stock got a new valuation. Okay? So that's why these C corporations, old C corporations, have tremendous tax liability. Okay, so you're asking two different questions. Okay, if I was arguing before the IRS on a federal estate tax case, okay, and arguing for a minority shareholder interest, discount to reduce the values of the shares of stock, okay, that's one of the ways these big pies would drive down the value, is we'd be talking probably 30%, somewhere in that neighborhood. Okay, now when you get done with your C corporation, you've got minority shareholder discounts and you've got this built-in tax liability to deal with. So it might be possible to get that stuff down to 50% valuation. Okay? Go back and say, well, if they don't sell it to you, then who can they sell it to? Okay? Because there's a willing buyer and the willing seller. If there's no willing buyer, that's going to discount those shares even farther. Okay? So again, you know, it's taking a look at these trusts. So maybe, you know, you might have one entity. A lot of you maybe have an entity that's a farming entity, and you might have another entity that owns land, or you might own the land personally. Okay, so it's a real trick into trying to figure out how this property is all held, and how you can transfer that and keep control of it. You really don't need to own the corporation. You just need to be able to control the resources. What the tax advantages of a revocable living trust? There are none. Okay, so why would you put it into a trust? Okay, you may think that paying 2% probate fees to an attorney is too much, but again, oftentimes we'll see trusts being published and notice given on those. And I think the other thing is that, well, nobody at this table, but I saw somebody at the back that I'm not sure about their mental competence. Okay? They were all right when they set up the trust, but in a year or two, they may not be able to function very well. Okay? So when we set up this trust, one of the things that we might look at, and we should be looking at, is successor trustees. Okay? So do you have a daughter or a son that would step into that and take over and run that company while you were incompetent? And about a third of my clients today will end up in that category, right? It's with our ability to live long. And so we had another case in Story County that I worked with. Mom ended up with Alzheimer's. I shipped her out to Colorado to be with her daughter. Daughter came back, cleaned out the house, sold the house, did all of that. How could she do that? She was the successor trustee. We had 2 doctors that signed off that Mom was incompetent, and the daughter stepped in and took over. Okay? So that's another benefit that I see in setting up these trusts, even if they end at the death of the person that set up the trust, is this just ability to manage the property with incompetence. Doesn't do anything for taxes. Okay? Now, when say you set up a trust and you put half your real estate in it and you die and your wife is the successor trustee on that and your children are going to be the eventual beneficiaries, okay, at that time, then the trust will have to fill out a tax return. But prior to that, the revocable living trust, will not fill out a tax return. And again, trusts do not keep income, generally speaking. If you look at the income tax bracket on a trust, it's very, very high. It goes to like 39% at $10,000 of income. Okay? So how does the trust get around all that? They push the income through to a beneficiary who gets to pay the tax. Because this corporation has some retained earnings that were never taxed, and it's about time you pay those. Oh no, you don't have any cash. Okay? There's a difference between having cash and having retained earnings on paper. Okay? And that's so one of the ways to get around that is to declare some dividends every year, okay, and bleed down your retained earnings. So it's kind of think like a co-op. You tell your husband that he gets $1 of tax liability, and you're not going to send him any cash. Okay? He won't like that, but eventually you'll get it to the point where you can spread out that tax liability over several years and eliminate it. The other thing is you can just die owning it, okay? And that will take care of your retained earnings tax liability. Well, we're going to dilute those shares of stock even farther, okay? So part of this is I had a guy up at Dyke that wanted to set up a generation skip trust, okay? And he was going to skip about 5 generations. And, he wanted to maintain this old dairy farm. And I said, what you're thinking all wrong. What you need to do is to find a grandson because your son is too old already to start up this business. If you find a grandson that wants to farm, start him out farming, transfer that farm, those assets of that farm to that child that's farming and keep it in that business. Okay? Everybody thinks that, these shares, you create a corporation that's got 100 shares and you got 3 children. They each get 33 1/3, right? Well, they each have 5 kids. Now we're down to what? Each got 6 shares, okay? And so it maybe facilitates somebody who wants to buy them back. But a lot of times I end up with these 5 dysfunctional children. None of them had a pot or a window, okay? And, it's just challenging. Okay. So, again, you can look at these trusts. Again, most of them all are going to be revocable living trusts. That's 90%. You might have a testamentary trust. That's what us guys set up when we were children. We had little children. If we died, we wanted somebody to take care of our children until they were of age. I certainly don't want my children to get any money until they're about 40 years old. Maybe they'll grow up a little bit by then. You can do it with a charity. There's life insurance trusts. So if we're going to fund some of those buyouts of those other shares of stock and buy them back or that other real estate, we might use life insurance to do that. Well, we don't want to own the life insurance ourselves because it'll get included in our estate, so we'll put it in a life insurance trust. Keep it out of our estate. I've got a friend of mine that donated some apartment buildings to the Catholic Church. I known him for 50 years. He could use a little salvation. I don't know if he thinks giving $500,000 worth of apartments to the church is going to help him with that. But he got a charitable remainder annuity trust back. Okay, so if he'd have sold that apartment complex for $500,000, he'd have paid $200,000 in tax. He'd have had $300,000 left over. Then if he would have died, he'd have paid another $1.2 million in tax. His kids would have got $1.8 million. All right? So instead, let's give that to the church, and let's have the church send us a check each year, and we use that check to buy a life insurance policy that's in a life insurance trust, okay? And that trust isn't included in our estate, and that life insurance policy goes to our grandchildren tax-free, okay? So if I can buy a policy for a couple $1 million with that income stream, say I'm getting 5% on, that's $25,000 a year. If I can get, and he can do a joint life, so he gets his wife in there because his wife is healthier than he is. why we can end up with the kids getting more money, and we got our name on the front of the little schoolhouse that the Catholic Church built. Okay? So again, I'm going to the teachers' party next week in Iowa Falls. It'll be paid for. Somebody said it was going to be paid by Jeff Hansen. I don't think that's true. It'll be paid by the Jeff Hansen Foundation, right? Okay. Really interesting strategies for our wealthier incomes. Okay. Generation skip trusts. All right. So again, going back, take a look at how property is owned. Take a look at insurance. See if there's a role for gifting. And again, think about, do you give it away during life, at death, or sometime after? And then put the plan in place. We talk about durable powers of attorney. That might be one thing to help manage property while you're still alive and you're incompetent. Bank accounts, you can have transfer on death or payable on death titles for some of those things. Okay, so Aunt Vera is pretty well shot. Sold her house, put her in the nursing home, and so everything she's got is titled payable on death to her daughter. We're not going to go through probate. Yes?
Disclaimer trust.
Disclaimer trusts. Okay. So a tool to use where you're not sure what the value of assets might be in the future. You're not sure if you want the income, and so they'll set up a provision so that you can disclaim property. And then the trust is going to say who gets that property if you don't want it. Again, it's a tool. I don't know, Aaron, if you're seeing much of that being used. Not a lot, but you do have the right as an heir to disclaim. Okay, I have a family that I worked with. Their parent died. 3 children inherited 160 acres, and Bubba has a problem with the IRS. And I don't know what his problem is. I've tried to get it out of him because I think we could clean it up with a bankruptcy. But anyhow, Bubba has a problem with the IRS, so he disclaimed his inheritance. So it went to his 2 siblings, because if he would have gotten it, the IRS would have just taken it. Okay? I think there was something called fraud involved in that. Okay? And so you may not be able to get rid of fraud with bankruptcy. All right, life insurance. Talk a little about life insurance. One of the things you should go home is have your life insurance agent send you an updated list of your policies and future projections on what they're going to look like. All right, with these low interest rates, we're seeing a real problem with universal life contracts. Okay? You were going to put money in a bucket. The bucket was going to draw 10, 12% interest. You're going to take a little bit out for those that died and build those new buildings here in Des Moines. But this bucket was going to boil over. All right. These buckets are starting to run dry. Okay? So you'll get a letter from the insurance company that goes like this. We'd like to double your premium. You're 80 years old. How's that sound? No? Okay. How about we just cut your coverage in half? That's what happened to you? Okay. And your third choice is, well, let's just call it quits. Okay? You had coverage, we had some money, we'll call it even. Okay? All right? So if you're going to, it's important to know that that's going to happen to you before it happens, so you can maybe have some more choices. Okay? But again, I'm seeing those letters show up. Okay? Again, advanced directives, power of attorneys, durable power of attorney for your financial affairs, power of attorney for your health care. All those things are talked about in a lot of the ARP magazines. Okay. All right. We're going to go through that. Long-term care insurance. There's a good document on that from SHIP. Okay, S-H-I-P. Living wills. Okay, I'm going to click through that. Okay, just of interest. Gives you the history of those tax brackets on the federal estate tax. If you go to the Ag Decision Maker website, my book is online at this link here. Okay, it's called. It's under the Evaluating Your Estate Plan materials. There's terms. There's publication on property ownership. There's a publication on different business entities. There's a publication on the estate settlement process, power of attorney, farm transfer strategies, retirement planning, the 3 pages on the Iowa inheritance, estate planning goals, so you can print off that sheet and each do your own goals. We've got a publication on gift tax, federal estate tax, and Iowa inheritance tax. We've got a publication on trusts and estate planning attorneys, finding one that you want to work with. Okay? So all of those things are free online. There's Estate Planning Questionnaire, C4-57. Okay. And so if you want to kind of start to put things in order to get ready to go talk to your professional, and you don't want to burn up $200 an hour sitting in the lawyer's office, okay, you just work through those 17, 18 pages, and it'll ask you some pretty basic questions like, how many children do you have? Okay. And it'll even ask you about, my cousin Ronnie, when my mother went to his last wedding, she says, this is the last damn toaster you're getting. 4 is enough. Okay? All right? Ronnie is since divorced. Okay? So again, the question that the estate planning attorney should ask you is, do any of those divorce decrees have any impact on your estate plan? Okay? Because there might be something in that divorce decree, one of those 4 that Ronnie has, that says that former spouse has the right to reach out and touch what becomes his. Okay? So, again, prenuptial agreements, you should think about that before you got married. Okay? On the second one, yeah. You didn't get that done, Aaron, before you got married? Should have thought about that. Yeah. Well, prenups on second marriages are quite common. Again, it's just we got her stuff and his stuff, and maybe you want to keep it separate, maybe you want to go to different places. And so working through that is a big deal. Okay? There's some stuff to help you on farm transition planning. The Iowa Beginning Farmers Center has the business succession program. We've also got the Farm On program. If you don't have any family heirs looking for some, we've done several beginning farmers non-related parties. Those have actually worked out quite well. But again, there's that goal setting sheet on that website. These power of attorneys should be up to date. Again, think about when you want to make some of those decisions. On gifting, again, some of those kids, a little money now will do a lot more for them than it will when they're my age. Okay, if I'm at the point in my life where mother gives me a gift at Christmas and it's always nice, but do I buy anything with it? No, I just throw it in the bucket. Okay, young kids getting started on their own business or getting started with a house, a lot of things. Okay, we talked a little bit about Bubba and little Johnny. Most people really don't have any idea of what the value is of those. We did put together a spreadsheet one time to look at trying to value the contributions of the on-farm heir. And a coworker and I had an argument. I kept coming up with negative numbers, and he kept coming up with positive numbers. So again, it's data you put in, data you get out. It's how you look at it. All right. So again, on-farm heirs. I think use of trust is a great tool for them to look at. Okay. In there, we might talk about first a right of refusal, to buy, to rent, whatever. We might take a look at buying at a discount or renting at a discount. But again, controlling those assets, not necessarily owning those assets. Okay. The Center for Ag Law and Taxation has some publications on estate planning. You can go to that website as well.